Hello and welcome back to the Wall Street Petting Zoo. This week at the zoo is our weekly newscast where we review the market news for the week. I'm Christopher C. Smith.
And I'm Robert Coburn. And in the news this week, Monday and Tuesday, the market pulled back on pessimism around trade talks with China again. Remember, December 15th is that deadline date on which the U.S. slaps on an additional $156 billion on new tariffs on consumer goods from China, like shoes, smartphones, and clothing. This would be something like a 50% tariff hike, and it would represent a major escalation of the trade war.
And Wednesday, the market moved higher after Fed Chair Jerome Powell announced that the Fed plans to leave interest rates alone this year. There were some current concerns among investors that the Fed might consider raising rates later in the year, since we do seem to still be in an economic boom and the fears of recession seemed somewhat overblown. Folks were afraid that the Fed might put interest rates back where they had been before the interest rate cuts of the last year. So Powell's comments allayed those fears and convinced the market that the Fed is going to leave interest rates alone for the foreseeable future. So that sort of gave the market a green light to continue moving higher. And there was also some optimism about trade talks on Wednesday as investors speculated that Trump might delay the tariff deadline or might sort of make an 11th hour deal in order to prevent new tariffs from going into effect.
And Thursday morning, the market surged higher on renewed trade optimism. This despite some really bad jobs data showing that jobless claims last week were 25% higher than analysts expected. This was the worst week for jobless claims since September 2017. Thursday afternoon, Trump tweeted that the U.S. was very close to a big deal with China, and a source in the White House told CNBC that the U.S. had offered to delay new tariffs and also repeal half of the existing tariffs. The market ended the day at all-time highs.
Yeah, so with that jobless claims report, Robert, I later read some analysis of that and discovered that basically because the Thanksgiving holiday was a week later this year than it usually is, that introduced some noise into the jobs numbers. So normally last week would have had the higher jobless claims and this week would be lower, but it was reversed. So last week we had a really good jobless claims report, one of the best in recent history. And this week we had one of the worst jobless claims report in recent history. So to some extent, this is just probably a blip due to timing. So we'll have to see in coming weeks whether the numbers stay bad or whether this is just a temporary anomaly in terms of those jobless numbers. But Friday morning, the market started the day lower on pessimism about China's response to the U.S.'s offer, because there were some early reports that China had not agreed to the trade deal that the U.S. had offered on Thursday, and that they were going to hold a press conference in which they would clarify their views on this. But then when the press conference actually happened, China announced that it had, in fact, agreed to a Phase 1 deal with the United States. The deal was a little bit more vague and a little less substantive than the market hoped. Those Thursday reports had indicated that half of the existing tariffs were going to be repealed. And what actually turned out to be the case is that $250 billion of Chinese imports are going to continue to have 25% tariffs on them. It was only on $150 billion worth of imports that we had cut the tariffs in half from 15% to 7.5%. So the bulk of the tariffs are actually remaining in place, but we are going to repeal a portion of the tariffs on $150 billion worth of goods. Also, the U.S. won't impose the new 15% tariffs on $160 billion of consumer goods that were scheduled for December 15th. So it was overall, a slight de-escalation of the trade war, but not a complete cooling or thawing of the trade war. And in return for the repeal of these tariffs, China will purchase $50 billion worth of U.S. agricultural products. So this should be good for soybean farmers in particular. And China will also, quote, consider canceling retaliatory tariffs that are scheduled to go into effect on December 15th. I assume that they will consider those they will cancel those retaliatory tariffs because there's nothing to retaliate against now. But it's interesting that the news reports used consider for canceling those tariffs. So this deal was vaguer than the market wanted. And unfortunately, the deal also doesn't include a timeline for scaling back those existing tariffs. So we have a sort of promise that tariffs are going to be cut from 15% to 7.5%, but we don't know what timeline that's going to happen on. The deal appears to primarily benefit U.S. farmers who are going to get the $50 billion of Chinese agricultural product purchases, retailers who were going to be the primary ones hit by the December 15th tariffs if those had gone into effect. So retail companies that import goods from China are going to be benefited by this, and energy companies. So a lot of the tariffs that are being cut on the $150 billion of imports, a lot of those are energy products. So we're talking, oil in particular was the big beneficiary from this. Oil prices spiked on Friday and broke through a critical resistance level. There's a trend line that oil prices broke through and may continue to rise early next week, although we closed below the trend line, which suggests that the market hasn't decided yet whether oil is going to continue upward or not. So watch oil prices early next week to see if we get a continuation of that move upward in oil prices. But that does seem to be the major beneficiary of those tariff cuts is oil companies.
It's really odd that we're just mainly focused on that $50 billion of U.S. agriculture equipment. I thought it was, was it equipment or was it food and soybeans? Because I know that was one of the big things is that soybeans basically just sat in a lot of farmers silos because China basically stopped importing soybeans from us, and we completely ruined the soybean market.
I think it's primarily food. So soybeans being the big one, but there's also pork is another big export that we send to China. And they had drastically cut back on their pork purchases. And so food banks across the United States have been filling up with surplus pork this year. Homeless people have had a lot of pork to eat. Personally, I think it's weird too. Number one, if China makes a one-time purchase of $50 billion of U.S. agricultural products, that doesn't necessarily help the U.S. economy that much. It's not like a sustainable boost to the U.S. economy. It's just a one-time shot in the arm. So it doesn't seem that meaningful. And plus, our main objective in the trade war has been to get concessions on theft of technology and on Chinese currency manipulation. And those things seem to have faded in the background in these trade negotiations. And it kind of seems like Trump is just looking for sort of the symbolic victory of getting those U.S. agricultural purchases, which I guess makes sense because that's his constituency, right? All of those Midwestern farmers were, heavy Trump voters. And so he's got to show them some kind of meaningful impact on their business in order to continue to get their votes in the next election. So I think this is largely politically motivated, but it certainly doesn't seem to solve the core problems in the trade war. Interestingly, I was looking for Caterpillar to jump on this news because Caterpillar and Deere have both been very closely tied to trade war progress. But those stocks actually did not benefit on Friday from announcement of this deal. And I think that's because really we're not seeing tariffs reduced on equipment. We're seeing tariffs reduced more on the food products. So
yeah, because originally it was on equipment, and then now it's saying agricultural products. And this reminds me of I don't know if you have Xfinity in Albuquerque, but whenever you try and sign up for internet service or you'd make any change to your bill, they try and tack on their quote unquote triple play, which is including TV, which some people get. But they also add, they're like, hey, you need a phone too? Like a landline phone? And you're like, no, I don't. But they really want to try and sell you on that phone. And they'll be like, we'll lower the price on everything else if you get the phone too. And you're like, I'm not going to use the phone, but they still want to sell you the phone. So it's kind of to me, it seems like that type of situation where they're really trying to sell you something you don't really want, but you kind of take it anyways because you want the better deal.
Kind of a bait and switch a little bit, huh?
Yeah. Anyways, so what stocks were you watching this week?
So one of the stocks that I watched was Baidu, which, if you recall, is a Chinese search engine company. It's called the Google of China. And Baidu also owns a large share in IQIY, which is the Netflix of China. So this is a major China tech giant, and also has been investing heavily in AI. They've filed almost 6,000 AI related patent applications in the last couple months. So I've been pretty excited about Baidu, and it was up almost 3% this week. So pretty good week in Baidu, and I'm definitely going to continue to watch this. I think that this is still a pretty undervalued stock. And I also think that it could benefit from cooling trade relations between the US and China. It definitely dropped on Friday, so the trade war news did not generally benefit Baidu. But I think that maybe next week we could see Baidu get juiced a little bit as a result of the thawing trade relations between the US and China. My other pick this week was Cassava Sciences. This was my short term sort of multi day swing trade. If you'll recall, Cassava Sciences came out with some really positive clinical trial data on an Alzheimer's drug, and it had popped before it had popped at the end of the previous week. So last week I was saying, if it drops to 170, buy some, and if it drops to 140, buy some more. Cassava did hit the first buy target at 170, and then it moved to over $2 a share near the end of the week. And I sold my shares at $1.91 for over 12% profit from that $1.70 buy point. And then Cassava ended the week at $1.88. It's looking weak right now, so if you're still holding, then it's probably time to exit Cassava right now. But that did turn out to be a pretty profitable swing trade this week with about a 12% profit for me.
Nice. So this week, I was looking at a bunch of stocks. I had such a long list last week that I had to curb it down to, I think I did 5 stocks. So the first one I looked at is AutoZone, and I honestly did not expect it to keep going higher, but it jumped 8% on reporting sales that far surpassed expectations. So a few times it eclipsed the 1250 mark, basically setting more new highs for AutoZone, but it settled back to about 1230 at the end of the trading on Friday. GameStop, and remember how bad I said GameStop is performing, they posted another weak earnings report. I don't know how anyone is surprised by this, but the stock dipped again after the CEO put the blame on the fact that consumers are waiting to buy next year's consoles. I don't know who he's trying to fool, but I mean, most companies nowadays do not make a single dime on consoles. So him putting the blame on a console that's coming out next year, I don't believe this is the problem. As I stated last week, this is a company that's a sinking ship, and I think the CEO appears to be incapable of turning the wheel. So he doesn't know how to pivot the business. He's just basically the ship's on autopilot and it's heading straight for that iceberg. He's not trying to pivot or do anything to help GameStop recover or do anything different to be a better business. So again, do not expect anything from GameStop. It's a sinking ship right at this moment. So unless they, like I said, somehow reinvent themselves, they're not gonna move upwards. Dave & Buster's, now total operating costs increased 89% year over year. This is a red flag I saw in their earnings report. They have a current total of 135 locations and are looking to expand to 200. So despite reporting better than expected quarterly numbers, I don't feel like expanding this quickly without curbing operating costs is a good long-term play. So it may look good for the short-term investors, but I get the feeling that this stock is not a good long-term play because it doesn't show me that this is a viable way that this company can basically make money. Because they're saying that their newer locations are making more money and their older locations are hemorrhaging money. So obviously, if you're not, fixing the problems behind you, you're just going to leave a wake of destruction. So again, not a good long-term buy. Lululemon, they reported third quarter earnings that beat Wall Street expectations. However, they lowered their fourth quarter guidance. It didn't drop down as bad as last year's sell-off. So, but I don't think it now is the time to buy. I would advise waiting until the end of the year, as the end of the year approaches, before buying into the weakness here, because it will go back up. Lululemon is a strong product. A lot of it's basically like the de facto yoga, the de facto yoga apparel wear. So keep this on your radar. Adobe. Now, when I talked about Adobe last week, I believe I was looking at the wrong chart, because I believe I said they were trading below the 300 mark, but in reality, their nose was just above the waterline, floating right above the 300 mark. But when they reported their earnings this week, they flew out of the water and into an all-time high for Adobe. Their cloud business software is booming, and there is no one really out there to compete with their product line. So anyone looking to make some money long term or even short term, I believe Adobe is a good play.
Wow, I missed that Adobe earnings report this week. So I had Adobe a couple weeks ago, but I think I sold as soon as I saw like a 5% profit. But now I wish I'd hung on.
Yeah, it jumped. I think. Let's see. What did it end up on? It ended the week at 317, but it was jumping up to about it hit almost close to 325.
Wow, fantastic. That's great. You know, my girlfriend and I go to Dave & Buster's sometimes, and it's got some competitors now. There's Round One and a couple others that typically have newer games than Dave & Buster's does, but also charge more money for, admission and per game. So I think that probably on like price, Dave & Buster's is fairly competitive, but I haven't seen them do a lot to like make their product more competitive. Kind of seems like they're falling behind in terms of like just the appeal of the games that they have, and they're not really adding new games and new things to do at Dave & Buster's. So I agree with you that it seems like a stagnant business model. And even though they're expanding their number of locations, I think that probably their per location numbers are going to continue to decline, especially as new competitors enter this space.
Well, it's one of those things where, it's the shiny new toy in your neighborhood. You guys, everyone's like, oh, we got a Dave & Buster's, and they go there and they spend some money, and then they realize, wait a minute, I don't really feel like going here anymore. I'd rather just go to the neighborhood bar and, pay the bartender, or if I'm going to play games, play video games at home, not really going to spend the money to play video games at a giant Chuck E. Cheese for adults.
Yeah, well, once you've played all the games a couple times, there's not much to take you back there. Some of the competitors are doing things like they'll have bowling alleys inside. They'll have, other kinds of social games and stuff. Round One, I think, has like 99-cent ice cream to bring you back. But I don't see Dave & Buster's doing any of that sort of innovation to sort of expand the business model. So, all right, let's talk stocks to watch this week. I'll go ahead and get us started. One stock that I'm going to continue to watch, Baidu, by the way. I think that Baidu has, great long-term potential. It's still, I think it's about 120 right now, and I do still expect to see 200 within a year or two. So definitely one that I'm hanging on to. One stock that I'll be watching for an entry this week is Zumiez. So Zumiez reported its earnings not this Friday, but the last Friday. And both sales and profits beat Wall Street expectations for the sixth consecutive quarter. Zumiez popped after its earnings report on Friday, but then it fell all this week. I bought a couple shares at $32, but I think the bottom is probably going to be either 30 or 31 before it bounces higher. So I'll sort of scale in. I'll buy more at 30 and then, or more at 31, and then another large position at 30. Based on the updated earnings forecast, I estimate that Zumiez is worth about $37 per share. So that's the price that I will target for my exit. I've definitely been watching the analyst forecast for Zumiez earnings go up, even as the share price this week has come down. It looks sort of nicely, juicily undervalued right now. So I'm looking to enter Zumiez, for the largest position at the $30 mark. I'm also holding Snap over the weekend. Snap has been going up all week, and I think Snap is worth about $16 per share at a minimum. Last time I looked at it, it was about $15.15. And possibly Snap is worth quite a bit more than that because its earnings forecast suggests that its earnings are going to accelerate quite a bit in the next couple of years. So as its earnings outlook continues to improve, I think Snap could rise even higher than that, maybe into the upper 20 range. I'm also holding Aurora Cannabis over the weekend. So Aurora Cannabis is one of those weed stocks that in the last couple of years has been a real roller coaster because there's been a lot of hype around marijuana stocks as marijuana gets legalized in more and more states. And Aurora Cannabis was one of the big beneficiaries of that about a year and a half ago. But its stock has been in a downward slide all this year. I think that it was way, way overvalued, and its valuation is finally looking reasonable. It's actually a little bit undervalued right now. I think that Aurora Cannabis probably has reached a bottom at the moment. And as we head into a new election, there are marijuana legalization bills on the ballots in something like 8 to 10 states. I think also that Aurora Cannabis is poised to be very competitive in the Canadian market because I saw an analysis that suggests its overhead costs are way lower than any of the Canadian cannabis growers. So I think that Aurora Cannabis could get I think that it's poised to improve its competitiveness in the Canadian market, and also it's poised to benefit from potentially quite a few ballot initiatives to legalize marijuana in a number of different states. So we may see the hype around Aurora Cannabis start to grow again as we head into this election season, and now is probably the time to pick up some shares of that stock.
Coincidentally, I traded Aurora Cannabis stock about 2-3 years ago. So my coworker actually talked me into it because I was before I was trading Aurora Cannabis, I was heavy into penny stock trading with medical marijuana stocks because there was no real recreational stocks on the stock market at the time. It was mostly all medical, and so I actually bought in around the $2 mark in 2017. And when I saw it shot up to about, I think it was at the $6 mark, I was like, okay, it's time to get the hell out of here. Take my money and run. So I took my money and I got out of there. And then I saw it reach up to 10 and I was like, maybe I ejected too early. But I warned my coworker who actually told me about this stock, and I told him, ring the register. You need to take your money and go, because he invested a lot of money in the stock, and I was like, you need to get out. And when the stock started to fall, he's like, no, I'm in it for the long haul, and I'm like, this isn't a long haul stock. And he was just adamant about not selling it, and I don't think to this day he sold it. And I'm just like, you could have sold anywhere above like the $6 mark and recouped triple your money, and then taken the original amount you invested, put it back in your savings, and then play with house money.
Or even buy back in at the bottom,
Yeah, and coincidentally, the funny thing is this week I actually put it back on my watch list because I saw the price that it was at right now, and I was like, I'm pretty sure I'm up for trading it again because this is a very attractive price point. Like I feel like with the current climate, as you said, with the elections coming up, especially because this is a primary election. So basically with that, with more people voting this year, I believe that, and I agree with you that this is probably a good time to invest in Aurora Cannabis. Or I got to look into, because it's been a while since I've traded cannabis stocks, so I got to go back and look at all the new players in the market for the cannabis market. But I know it. I used to say it was like the next big it was like the next tech boom. I used to say like 3 or 4 years ago about cannabis stocks, and it's kind of cooled down a lot, especially around the hype with Aurora Cannabis. I feel like Aurora Cannabis's stock trending line was basically reflective of like the hype around cannabis stocks. So the fact that it's at near the bottom, it shows that it's got nowhere to go really but up.
Yeah, I mean, the thing about hype like this is it goes through cycles, you know? I mean, you have like cryptocurrencies like Bitcoin, and you will see them, you know, soar toward 15,000 and then plummet back down to like 2,000. But then the cycle will start all over again. And potentially we could see that with the cannabis stocks. We could see them, you know, climb back toward outrageous, overpriced highs again. So, but even if that doesn't happen, I think that this is like a solid price for this stock, just in terms of sheer fundamentals. So even if you don't buy into any of the outrageous hype around the cannabis stocks, this is a good value anyway, at this current price. So, you know, I'm sort of hoping for the hype cycle to start all over again. But even if it doesn't, I feel good about this investment. I think that this is a solid investment right now.
What would be your price point if the hype train started again? Like, where would you exit if it not necessarily repeated what happened last time, but if you, let's say you entered in at 250, what would be your target exit?
Yeah, actually, 250 is right about where I did enter. I mean, I tend to play trend lines, you know, so I basically would watch it climb. And then when it starts to like break beneath the upward trend line, then I would sell it, and then I would buy it again if it starts to look like it's at an attractive price again. So I don't tend to, you know, just hold these things until they hit a particular target price. I look for, you know, where is it on my trend lines? But if I were going to just like set a price target to look for, I might go for something sort of nice, middle of the road, like maybe a 630, 615 is kind of like a nice level that it's spent a lot of time at. It's got some resistance there because it's a historical price that it's spent a lot of time at. So I wouldn't necessarily have faith that it could break through that level and head up toward like the $12 range again, which is where its highs were previously, were right around 12.50. I wouldn't necessarily want to bet on it doing that again, but I would look for it to, you know, maybe hit like the 615 or so again. I think that that's a reasonable target to shoot for if the hype cycle starts over again.
Yeah, I was also looking at the $6 mark. That was what I was looking at. Anyway, so the stocks I was looking at, or I'm going to be looking at next week. So FedEx, this is I seem to be targeting a lot of companies that I know are not going to be doing well, and FedEx, I believe, is going to be another one of those companies. Now, they recently ended their contract with Amazon, so we'll see how well these guys do during this holiday season, you know, where everyone's shipping everything because everyone's buying everything online, or they want to buy gifts for, you know, their friend who lives on the other side of the country. Typically FedEx has been a part of that, especially with Amazon. But now that Amazon has, you know, started making delivery service a part of their own core services, and them ending their partnership with FedEx, I don't believe that they're going to be doing well. They're still doing well in the stocks. I mean, their stock's still valued about a little over 150, trending in at about 165. But ever since they announced that deal with Amazon ending, They've basically just been doing very poorly. They've been climbing back up, but I get the feeling that I think they report on Thursday. I think come Thursday they're gonna just report abysmal numbers and probably dip below the 150 mark. CarMax is also another stock I'm looking at. Now, these guys have been performing really well, and I believe I know the underlying reason why they've seen a recent resurgence. They started the end of last year at around the $60 mark, and now they're just shy of the $100 mark right now. And I believe that's attributed to the fact that about 3 or 4 years ago, there was a lot of people who bought leases on cars, cars from dealerships, and all those cars came back from lease, about 2 years ago. And so a lot of people either didn't buy those cars, or those leased cars just sat on lots. So those cars were either sold off to third parties like CarMax, and so they were able to turn those around and sell those, or basically people bought those cars, didn't like them, and then they just sold them off to like CarMax or other car selling companies. So I believe they're probably going to eclipse the $100 mark. I believe they did that earlier in the week. That was late last month. They briefly jumped over the $100 mark, but I believe they're going to solidify their position over the $100 mark this week with a strong earnings report. And then the last stock I'm going to be looking at is Nike. Now, Nike's always been in the middle of controversy with, supporting athletes that are very outspoken, and it doesn't seem like the backlash that they get does not seem to be reflected in their stock. With the whole Colin Kaepernick being endorsed by Nike, there was a lot of people who went on social media and started burning their Nikes. And the funny thing is some of these videos, you'd actually see them in the Nike bags. It was very apparent that they went out and specifically bought these Nikes just to burn them. So, I mean, that doesn't really work in terms of boycotting because you're still giving Nike money. So, I mean, their stock has still been trending up since the beginning of the year. I mean, it's still climbing. It's beginning of the year was at 72. Oh no, 75 was at the very beginning, and now it's up. It's just like with CarMax, it's about to eclipse that $100 mark, and so I believe Nike will report strong numbers as well. I mean, it's one of the most well-known brands in shoe apparel, so I expect them to do well this week.
Great. Well, if you heard something that was useful to you here on the podcast, if you like the podcast and want us to keep making it, please consider supporting us with a like, share, or comment. You can also find a referral link underneath our YouTube video that will send you to Webull. And if you open a Webull account and deposit $100, you will get a free stock. We will get a free stock. Good for everybody. Nice way to support the podcast. You can also tweet at us, follow us on Twitter, or like our Facebook page and share our posts each week. Help get the word out about this podcast. Hey, thank you so much for listening, and we will see you next week at the zoo.